All right, welcome everybody. Today we're going to go over defining structure in the markets. Not structured, defining structure. And we're thankful that Bookmap is hosting this webinar, and we're going to get into our fact-based trading solutions. Before I get into it, just want to go through the disclosure of futures. Crypto trading contains substantial risk. It's not for every investor. An investor could potentially lose all or more of that initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital that should be used for trading, and only those with sufficient risk capital should consider trading. Past performance does not necessarily indicative of future results. Everything we go over here today is going to be for educational purposes, but using risk capital is key, because if you don't use risk capital, you're going to make emotional decisions, and that's going to mess your trading up. My name is John Slazis from Dharma Capital Trading. I've been in the business for over 35 years. Have and still do have an analytics company. Been supporting traders through my career and trading the markets. Started on, in the pits and onto the screens, and got involved in crypto in 2013, and really heavily involved when Ether came on the scene. So if you want to get a hold of me, you can get me on Twitter or on our YouTube channel. We also have our Bookmap Discord channel. And everything we're all about is fact-based trading. It's really about having a real good baseline. So what is fact-based trading? It's making decisions based on objective data and analysis, to reduce speculation and subjective biases. Focusing on the facts. What's true? What's real? And when you know what's true and what's real, you can make better decisions. Your body knows it. Your body knows the difference between making a subjective decision and one based on knowledge and facts. It's just how we're wired. And Dharma Capital has a few resources to support you with, and I welcome you to go to our website, dharmacapital.trade, and take a test drive on our analytics, which is going to help you standardize your decision-making process. Our applications will help to normalize that into your workflow, so it'll be seamless. And participate in some of our other webinars and trader development programs, and that's going to help to optimize your tactics. The tactics for you, what your tactics are, not somebody else's, what you've developed, and how do you optimize those tactics. And our method is pretty straightforward. We are always defining what the context of the state is. What are those characteristics? What's the environment? And then we look for the alignment of structure points where that context will change. So what's the environment? When does it change? You're in your house. It's all nice, warm, cozy, and then you walk outside and it's raining. That's your inflection point, is your door. The markets are the same way. Where's the inflection point that turns the characteristics of the environment to the state? And then you align your expectations. So if we have this specific context and specific state, it's an if-then proposition. What's more likely to occur? So we are aligning our expectations with our trading decisions. And the results of this, by adopting an objective viewpoint, it's going to improve your confidence, which is going to improve your consistency and your self-awareness, and this is going to reduce your stress and elevate your performance. Sticking with a statistical baseline and integrating factual data points into your decision-making process. It helps to standardize things. It's not, one day to the next you have this sound structure to work with. And so in this presentation, I'm going to go through some defining structure terms, and then we're going to get into some live markets and go from top down, high level to the microstructure. So using fact-based structure for proactive risk management and to anticipate opportunity. So proactive, anticipate. Those are terms that define success in trading. Reacting, thinking, hoping, those are not. So if we're not able to anticipate, we're way behind. We're not going to succeed. You can't wait for reactive indicators. You have to be able to have awareness of what the context is, where that context is going to change, what's more likely to occur, so you can anticipate opportunities in the moment. And so I want to go over a few things, and everything we do is about building your foundation. So instead of diving right into the market and going through this, I want to make sure we lay the proper foundation so you understand what structure is and how we define structure. And there's so many different opinions out there, and that's the problem. There's too many opinions, too much subjective bias. And so we're going to go through the fact-based approach. We're going to talk about price structure, we're going to talk about time frame structure, and we're going to talk about market structure. And then we're going to go and apply it. So the common perception of price structure. So price structure is your price action, market moving, making higher move highs, higher move lows. This is just classic interpreting, reading a chart. And that's valid objective data. Now with crypto, since a lot of these markets are thin, they don't have as many market makers in them, you do get price aberrations. But fact is a fact. If you're trading on a specific exchange, they traded there, they traded there. But defining price structure, and basically to me that's just identifying those peaks and troughs. Is the market building higher move highs, higher move lows, or lower move highs, lower move lows? And if it stops doing, and then if it is, it's in the trend position. So here's a negative impulse where the market is this shorter impulse is working negative structure, and on a bigger basis we've kind of double bottomed here in this picture. And so where are those key structure points that will change? And those are important. Absolutely. The problem is when we start adding subjective indicators to it. We start identifying this high or that low, creating trend channels and more technical tools, and confusing things. What's true? What does that alignment mean? The big thing about price structure is just I call it the high-low game. Is it working higher, working lower? It's just tracking the momentum, and that's the base foundation. As you move beyond that, you have to recognize you're dealing with something subjective, and that's going to change things because that's your opinion. So again, identifying trending higher high, higher low, lower high, lower low price structure is a valid objective tool, especially on higher time frames. As you go into the intraday 5-minute chart, it gets real slippery because that's a time frame that the major funds don't really participate in. They're executing at that time frame. They don't really even care about the day. They're more backed out on higher time frames, but they do care about the close, and they do have to execute during the time. But so these intraday price structure, take it with a grain of salt, and don't weigh on it too big. Because when you start, and then conversely, if you're incorporating technical analysis, it reduces the validity of the overlay by the subjectivity. And that's going to get curve fitted based on your cognitive bias. What's in the background. It's hard. If you have a position on, for sure, you're going to draw it the way you see it, and the way you see it is what's beneficial to you. So having an objective tool is important. So time frame structure. that defines the parameters of the trade period, which aligns with fund manager benchmarks. So this is if we're going in levels of importance, and as you're making your trade decisions and you're valuing, how do you value an opportunity? And value an opportunity is big, because if we don't have different value and we can't standardize it, it's just, how did we wake up in the morning, we're going to trade big, or a gut feeling? No, it needs to be aligned with facts when we trade bigger. And so we need to build a foundation of what are the bigger truths, what's more important. Well, time frame structure is going to trump price structure. And this is something that gets overlooked by so many people, and it's so important. And it's really just identifying the what is the high, low, last, and midpoint of the previous trade period, because that's what really matters to the money that's really moving this market. And looking at it in terms of high, low, last for the day, the week, the month, the quarter, the year, and where's that midpoint? And kind of give you just a general bias between how we were performing the previous period to the current period. And so I just using those acronyms, here's an example on a monthly time frame structure. What's the previous month high, close, midpoint, low, and using these acronyms. And this, identifying this time frame structure, this is going to provide us insight to anticipate opportunity and proactively manage risk, by observing, price movement across various time frames, observing the price structure within those time frames, within that time frame structure. So getting having a sense and laying your foundation, and taking a big step back. What's the yearly, previous year's high, previous year's low? This is a picture of Bitcoin. We closed on the previous year's low and close were right together. That's interesting, because that's a good momentum level, just natural. And where's in the coming up to, we've gone through the previous year's midpoint, so things are getting interesting. What's the quarterly time frames? Where are we in relationship to that? Basis the monthly time frames. And really, what's your time frame from trading? And if you're daily, you better know the daily, you better be aware of the daily time frame structure. You should know the weekly too. The week is, weekly trading is a great structure. Each day is unique. And a daily structure. And how do these different time frames overlap on one another? And that's where you start to see alignment. This is where the alignment starts to come into play. And why is this important to time? Time frame structure is important to fund managers. Well, it's the benchmark for their performance. Time frame structure provides fund managers with objective, factual benchmark. Enabling precise evaluation and comparison of asset performance across distinct periods. This is what they're marked to market. This is how they make their money. This is their tear sheet that they're sending out to their clients. And it's critical. So how do we harness this? How can we use this time frame structure? Well, it helps us to identify market direction. It pinpoints the alignment. We can standardize our signal acceptance, and it can help us to manage our risk. So here's an example of daily time frame structure. We've got our structure high, low, midpoint, and close. And so just as simple as this, and just as again, what we're doing is we're defining context, right? We're getting some granularity of facts. What's the truth? What's more likely to occur? So if we're trading, above the previous day's high, what's more likely to occur is we're going to go higher. If we're trading below the previous day's low, what's more likely is we're going to go lower. And if we're buying the market below here, we need to understand what those risks are, and those risks are different. So we want to risk less. If we get a signal, get an exhaustive signal here, we want to risk less because we don't want to get caught in another one of these. And if we're stabilizing above the low, Yeah, it's more likely we're going to try to gravitate to at least the midpoint or retest the close if depending on where the close is. Same with the the high. It's if this is acting as a containment, then we're going to retrace to the middle. Simple as that. In the middle, the midpoint is going to act as a classic pivotal point. It's going to be rotational. It's going to just what's the general tone? What's the general bias? When you get a transition through the midpoint, it's going to act as an acceleration in that direction. It holds the structure. That's where the price structure starts to come in. How's the market performing? And the close is the net change for the day is always something that everyone's looking at. We up or down on the day, and where is that that close based within the time frame structure? Is it in the middle, off the midpoint? Is it near one of the extremes? But bottom line, you're higher on the day, it's negative. You're up on the day, it's positive. It is what it is. Those are just the facts. So it's a great tool to incorporate. And so on the next, so now we're moving up the food chain on on validity of what is the hierarchy in value of opportunities. And again, subjective things are the lowest rung, and that's what is most people think is the highest rung, and it's not. It's the facts are what is true and what the market is working off of, and getting in sync with those facts is what it's all about. And so as we understand price action and what price structure is, and we understand what time frame structure is, now we're moving to some quantitative analytics with market structure. In market structure, it defines the alignment of the state condition. So if you have a market that is we're trending, where are the structure points that are going to define that trend? And again, this is not based on price. This is based on more quantitative models than based on eyeballing a chart and viewing the peaks and troughs. But it's going to help to identify where those states change. Where are those alignment points where states change, and the market transitions from trending to non-trending, to then then it defines that non-trend consolidation range. And as it moves outside of that, it's going to identify the alignment of, okay, are we shifting into a negative trend? So the difference between market structure and price structure is identifying those peaks and troughs. Are we working higher structure or lower structure? Market structure is defining the structure of the state, the condition, and the points that are going to tell us that state is changing or in transition. And so this is what the money, the big money is looking at. They're looking at where states are going to change, where shifts are going to happen, where do I need to hedge, where do I need to make sure I'm fully funded. Those are the important points that the money is looking at, and the money is what's driving these markets. So market structure is not support and resistance levels, but it is the technical alignment of the market state. In our tool called Price Map, that's what it does. It defines market structure. And we call it our Price Map. And as we go through this and get into it, this is something we want to play around with. We welcome you to come to our site to test drive it. And we have and it includes our integration with Bookmap. But the Price Map structure identifies the alignment where shifts in states occur. And the beauty of this is it provides a framework to standardize trading tactics with the best risk-defined opportunities. So you have this structured overlay that is there in the market, and it doesn't move. And it's there from the start of the period. And the foundations of the price map are the critical range and our sentiment bias. So critical range is you can think of it as the upper containment level, and as the upside pivot, and the downside pivot is the lower level of a neutral digestion. Basically a non-committal structure. I call it, it's more of a behavioral bias where the market hasn't made a decision yet, basically. And the midpoint of that is what we call our directional. It's a pivotal point within that structure. So above that price, the market's going to try to press it to the upside. Below the directional, it's going to try to press it to the downside. It's just more, this is defining the structure of the state condition, and is that state condition true or not true? Are we breaking structure or holding structure? And our sentiment bias is an over-under number. This is the most basic point that money looks at. You're talking about a daily number. This is a daily number. They're looking at where's sentiment going to shift from up to down. That's it. And and that point really can skew the context of the state. So if we look at a market, this is a market neutral digestion, and we have a critical range that neutral digestion is a sideways state. Critical range is going to define the boundaries that define that state of digestion. And the sentiment bias is going to tell us, is there a bias or no bias? In this example, there is no bias. This is more pivotal because sentiment's in the middle of this context. So for the critical range, bottom line, its market structure is identifying if we're going to hold structure or break structure. And if we hold structure, then the expectation that the conditions of the state will persist. So this is when trading seems easier because the market's performing to the context, the characteristics of the market state, or is it transitioning to a new state? And when markets transition, it's more difficult. That's when trading is more difficult because we're not sure what that market is transitioning to. We do know that if the market's been digesting and going sideways, a lot of times when digestive states transition, they bust out and they have an accelerated move. So we have something to expect. If we're really going to get a valid breakout, the thing's just going to go, and we're going to see it. And if it's not going, that's a tell that says there's a problem. So that's the power of having an understanding, expectation of context, so that when if we know that the market's in a sideways neutral digestion, we're going to be fading moves. Those are the tactics we're going to lean on. That's where we're going to put our size on. And if the market starts to break structure, we're not going to hope that our fade trade is going to work out. We're going to get out of it quicker, and then we're going to anticipate an acceleration. And if we don't get an acceleration, that's going to tell us that, hey, you know what? This is a messy trade. It's not performing it's not transitioning properly. This is going to be one of those days where it just goes linear sideways, and I don't want to trade this market, and I should find something else to do, either trading-wise or enjoying myself. And then the other key point is of the 3 points is the sentiment bias. And so this will skew the structure, and this is where I really start out my day every day looking at any market and whatever time frame is where's sentiment, because that gives me insight to that is the ultimate risk point, because that's where the bias changes from positive to negative. So ultimately any trade you put on, that's your ultimate risk. But it's also interesting it gives you insight to the characteristics of a state. So if bull trends don't go linear up, they go they have positive impulses and negative pullbacks, which a lot of times are vicious. But those troughs are higher and higher, and that's what defines it as a bull trend. You got the higher lows, higher highs. Well, when the sentiment's below the market in a bull trend, it's all good. Everything's in alignment. And when sentiment's above the market, all of a sudden you take a step back and you're like, hey, we could have a corrective move, and you can have markets that are in bull trend states that just go down all day and close on their lows, and then they usually open up and rally the next day. But basically it gives you insight that, hey, this market's in a corrective phase because sentiment's above the market, so I'm either going to break or go sideways. So again, aligning your expectation with context. And so here's we had some big moves in Bitcoin, and this is quarterly structure. So taking it out on a larger scale, really this is the, looking at, the start of the quarter, and what is the sentiment? So the sentiment bias for Bitcoin was at the directional at 27,605. And so this is defining it. It's the start of the period. The structure doesn't change through the end of the year. This is the over/under number for Bitcoin for the quarter. And you can see how the market rotated around that figure, and then had our event, news event that powered things higher. We pulled back, we stabilized above it. The market's rotating higher. This is what a sentiment bias is, and it's just classic, where the market's going to churn around sentiment, especially when it's balanced at the directional, and then it makes a move. Again, just aligning our context. So what was the critical range, or is the critical range for this quarter? Well, the upside pivot was 32,799. So the expectations for sentiment was, hey, we're above sentiment, we should make a play for the upside pivot. That's just what it is. And they did that. And not only did they do that, but they broke out through it. So now we have a break in structure. Now the market's broken out of its critical range. Things are changing. Something's happening. So the price map was, the extension of the critical range has what we call validation levels. And so these validation levels will validate the price moves. So as we're rotating around the directional, to validate a move to the upside pivot, the market has to breach what we call our critical range positive. And so we have initial challenge of that area, and immediately the thing rejected. Again, this is on a quarterly basis. And then the market stabilized here, and this is just really you can look at this as a ladder. Market, and the price map is kind of like a ladder. You climb, you go up a rung, or you go up and down stairs. A staircase here. And so when the market validated above the CR plus, that gave us high confidence the market's going to follow through and make a play for the upside pivot. And the same thing to do with break out of the critical range. So if the market's going to break out of the critical range, it's going to need to validate beyond the critical range extreme positive or critical range extreme negative. And so that's what's currently in play right now in Bitcoin, is that the market has broken out to the upside of the critical range, but it has not validated it yet. And so this basically 35,492 level is our validation point for an extended move in Bitcoin. And so the next part of the critical range is identifying, okay, well, if we break out of this critical range, where can we go? Well, that's where our target levels come into play. So we have upside target 1, upside target 2, upside target 3, and 4 is kind of an event extreme. So really, an upside target 1 is like our minimum expectation. Our expectation is it goes to UT2. Best case is UT3, and having a crypto event, you're going to see the market go into the UT4 area and even beyond, especially with these markets and the volatility we had with this new asset class. And so that's the market structure. So let's just, now that we've kind of gone through Bitcoin where we're at, let's see where we're at in real time, and let's apply some of these. Let's apply our price structure, time frame structure, and our market structure tools in both the higher time frames and larger time frames. Before we get into that, I just want to show our playbook. So our playbook defines the context. So for Bitcoin, the market state is bull trend. And so, really owning context is important. Really owning the, environment and the characteristics. If you play, you play a sport, we're in football season now, and you've got a game coming up, and it's indoors on AstroTurf. Okay, I've got special shoes for that. Or you're playing and it's raining out on grass. Well, I've got some bigger cleats for that. And you need to adjust your tactics to those conditions and you're prepared. And this is where you align your expectations. Is the market in a bull trend? Is it a bear trend? Are we in a corrective trend? Are we in a neutral posture? It helps to you understanding what the context is, understanding what behavior, what momentum's like, what the volatility expectation is, and not only understand what should happen, and this is really an expectation of what a bull trend looks like, but also having an expectation of when this market breaks structure, what should it do? So when a bull trend breaks structure, it's not necessarily going to shift to a negative trend. It's more likely it's going to downshift to a neutral trade. But then, from that that context, now we need to identify our alignment, right? So first we define the context, understand the characteristics, and then where's the alignment to those when those characteristics are going to change. And so that's what structure is, and structure is going to change what that environment looks like. So instead of, in this situation, for Bitcoin, we're in a positive trend, but sentiment is way below the market. And what do we know about sentiment? We know that sentiment is where the energy of the market is, because that's where all the fund managers are looking at. They are looking at this price point to say, this is where I need to make a decision. If we take this price point out, then we're no longer in a positive situation. And I might need to hedge. I might need to do something. And so today that comes in at 31,552 basis the Bitcoin perpetual contract. And we also know that there's good structure here at this 32,883, and this is what's making this a pretty bull trend picture. But since the energy of the market's down here, what do we know if the market's trading at these levels? It's pretty extended. Doesn't mean it can't go higher. We could be in an event situation, absolutely. But what's more likely to occur, the market's going to have a hard time generating interest to really surge. Markets that are more in balance. Let me see if we have one here. Well, even this market, as the sentiment starts to shift up, that's when you're going to see more of a powerful area, and especially when the market, the sentiment is balanced on a trending market, it really shows that this market is ready to make a decision and ready to make a move or not. So understanding that context is important. And this tool also helps to identify, what the market's paying out. What segment is the market moving in? We call those reward metrics, average price net distance. And so Bitcoin's trading in $887 segments. So you put a trade on in Bitcoin, that's your minimum expectation. At least you want half of that. At the very least, you're going for $443 on any Bitcoin trade. And risk-wise, we have a variance, alert distance, maximum stop distance. You're looking to, you're risking $124. Between, and you look for 1 to 3 at least, so you can risk even double that if you're going to go for the APND. So defining that alignment, and then the playbook also gives you your expectation, because it's identifying if we're in this state, if we're in this structure, then here's optimally the optimal opportunities, and then potentially hedge opportunities. So I wanted to plug that. So here's our daily. And I've got our previous period high, low, close, and midpoint on here. If we're identifying, so here's yesterday's action, and here's today. And so if we're looking at, is the market working positive price structure? Well, on a bigger sense, incorporating yesterday's low point, and we're taking this low point, yeah, we've got a market that's looking like it wants to building positive price structure. But it's all kind of interior. So if we really just focusing on the day here, what's yes, here you've got this positive impulse here, and then the market break structure. So just classic, on this impulse, there's a problem. The expectation right now is more sideways. Why? The market broke this impulse positive price structure. So more likely it needs to go sideways or correct before it's going to have another impulse that would look something like this. And so that's just analyzing what's happening on price structure currently, and we can get more into that with as we go forward when we get into the microstructure. But on a larger picture, we look at what's happening on the time frame structure. Well, market opened up, and it, as it always does, basically off the previous close, and then which is in alignment with the midpoint. So it's telling us that that this is the rotational area of this range. And then we have the market try to press it to the downside, make a play for the previous day's low, couldn't do it, and we stabilize above the midpoint, and now it's going to start to work higher here and make a play for the high, and it did. So building on this context. So we have sentiment below the market. So as we come into the session here, we know that sentiment is way below the market. And if the market starts to hold below the previous day's close and is net change negative on the day, we could see a play for the low, and if not, the thing could really tumble down to here. So let's put the critical range on, because we know this market is in a bull trend. So this is, again, when we talked about value of structures, price structure can get a little sloppy, and it can quickly become subjective. Time frame structure is the absolute. Those are absolute facts. Crypto-wise, if you definitely have the issue of what is the real price of Bitcoin with all the different exchanges. But whatever you're on, exchange that you're on, that's the data you have. That's what it is. But then market structure is quantitative, and it's not looking at these peaks and valleys. And here's our direction, here's our critical range from the get-go, and the pivotal point within the critical range. So what's really nice is when time frame structure, price structure, and market structure all come into alignment, and today they didn't. They were somewhat in alignment here at the upper metric boundary of the directional, because that was the net change. But the fact that the market held the metric boundary here, it holds the figure here, holds the directional here, because the expectation is if we're in a bull trend, the market should hold positive market structure. So once it gets above the directional, it should hold above the directional. And where should it go? It should come up to the upside pivot. And then this is the point that tells us that this bull trend is going to extend. So let's put our validation points on. So again, we're always aligning our expectations. What's more likely to occur? And so for Bitcoin today, the market played around the directional, got above the midpoint. This was giving us high confidence the market's going to make a play for the high of the day basis the time frame structure. It's also in alignment with the market structure, we had multiple breaches of this validation point that says, hey, we want to go higher, holds the midpoint, continues to work higher, we attain our upside pivot, and then we break out. But we can't validate beyond our critical range extreme. And this is where the microstructure comes into play. But when you're in this moment here, your expectation is that the market has made a big move. So we're talking about average price map distance. So you can look at this is an average price map distance from the upside pivot to the directional, and this is a half APMD. So you can see how the market is trading in these segments, and this is a segment and a half move. And we also know from the start of the session that sentiment and the buying energy is down here. So we know that an upside pivot breakout is not as sexy as a move or a signal because sentiment's way below the market. So there's not going to be a lot of energy. How much interest is really going to come in here? We also have to look at the narrative, and we know we've got Powell speaking later on this afternoon. So that's another reason that, hey, this market might want to might not follow through. So when you're in the moment here and you're seeing a lot of people get really anxious and trying to press it, and they're trying to press it into a figure, we want to see this kind of stuff happen above these figures. Above here, we want to see this intensity of trade happening on a breakout. When intensity is happening in front of it, it's hopeful. I hope it goes higher. But having the expectation, this foundation that we know that this is the potential extreme, we're looking for exhaustive events because that's more interesting. It's not that interesting to buy a breakout here because we want to buy it here. We want to, this is our optimal strategy, is to fade momentum down here or accept a reversal signal, which is the market goes below the downside pivot here, pops back above it, and that gives us a reversal signal. This is the money trade. And if we break structure, meaning that we trade above the critical range, but then we can't hold it, well, this is transitioning us from an optimal theme situation into a hedge strategy theme. So market structure gives us insight to anticipate, and this is what we're talking about: proactive risk management, anticipating opportunity. And this is what's happening currently. We're transitioning into a hedge strategy theme, which may or may not follow through. But what happened is the market was contained by the critical range extreme positive. It wasn't able to hold the metric boundaries. If we look at this price action here, the market should have held positive price structure and continue with it. It didn't. It broke positive price structure. Market structure, time frame wise, we challenged the high. Time frame wise, it played out as expected, and so this also gives you insight to potential exhaustion. Again, just improving awareness. So what we're talking about, improving awareness. We're improving our awareness that the fact that this is the previous day's high point, critical range extreme positive, and sentiment's way below the market, and now the market gave us a break in price structure. And we're in the middle on the time frame structure, but we're getting a reversal signal at the upside pivot. And so the expectation here is that we're not going to perform like the characteristics of a bull trend anymore. The expectation is we're either going to have we're either going to correct and have a negative correction, or we're going to go sideways. Because that's what corrective trades do. They're either going to go sideways or they're going to break potentially hard. And where can we break to? Well, since sentiment's below the market and that's positive, a reversal signal here would generally target the directional, because if the bull trend is going to resume, it should hold, ultimately it should hold the directional, because that's the key, that's our key point on the critical range, that hey, we broke out of the critical range. What's the lowest squeeze point that this thing can go to? The directional. We go below the directional, it's over, because now you're breaking market structure. You know, just as, you know, you can look at these points as your, you know, peaks and troughs, and this is the lower breaking point. And then the other thing that's nice about this area is that we have the previous day's close and midpoint. So it's kind of a natural, hey, we tested the high time frame high, now we're going to, you know, it rejected, let's go test the time frame midpoint, or the session close. Are we going to go net change, you know, let's go see if we can go net change negative on the day. But that comes into alignment here. And so what, you know, after you have this higher time frame context, that's when you can get into the microstructure, and that's where this tool is invaluable. And we can see, you know, the resting paper here that's also building up at the directional area, as well as the you know, just in front of that figure, you know, basically the net change. So you are, you know, you can see that bit larger players are interested in this area as well, and then so that's where we take the, you know, kind of the next step in our decision matrix is what's happening in the microstructure. And so when we see the microstructure aligning with the bigger picture, things start to get real clear. You know, so we had this intensity of trade into the extreme. Let's just blow that up. So this, again, this is what I like to look for, is of getting this excitement into a figure, and I did have some, you know, resting liquidity here, and then the market doesn't follow through, and you get this, you know, basically happening here. And so my minimum expectation here is a half APMD, so I'm minimally expecting it to come at least back down to the upside pivot. And this is classic price map action. You know, you're climbing the stairs, you go above one stair, you go to the next level, and you can step back to the next level, and then you keep stair stepping up. And then when you do this, it tells you, okay, we're starting to stair step down. There's an issue. But these, you know, identifying, you know, you've got these aggressive buyers coming in here, and it's like, oh, nope. But you can anticipate that, and this is something, especially if any kind of breakout signal, this market should breach this metric boundary and base above this lower metric boundary, and that should go. And when you look at the you know, the biggest moves up or down, that's how they perform. And if the market's not performing perfectly, then there's a problem. So then we have this signal here. I like to look, another good factual tool is the VWAP. So we, you know, having the VWAP coming in here, it's nice. You know, a lot of times the market, you know, getting the market below that, and when that's in alignment with market structure, then you really have something going on. And so the fact that the VWAP was in front of it, because you have to remember, the funds are coming in. I mean, they've got programs that they're just looking to enter at the VWAP. I mean, basically, they're just looking for that price. So you always have to anticipate liquidity coming in at this point. Change the let me change my volume bars here, or volume dots. Let's beef that up. do it up a little bit more. So what we're looking for now is validation that this reversal is true. So the expectation, so we can look at the price structure here, and we've got our metric coming in here at 34,800. Let me blow this up a little bit. So as we're looking at, price structure within market structure. So this is how we get our awareness. We're observing price action within market structure and our time frame structure. And so we have this market, we're building these higher lows, higher impulse highs, and we have a surge into our, what we know is the validation point and potential extreme. Plus we know that we've got our the previous day's high point is kind of just above that as well. So then they come back down and they break. So if we're looking at structure low points, this is our first structure low point break, right? So market makes a high, a low, and a new high. So that makes that the first structure low point breaking point, and then here's our second structure point breaking point. And so have this alignment coming in at the figure is a big deal, because we know that this impulse is broken here, and we have, we kind of have some multiple things coming in at this level. So it tells us that, hey, it should, if this market's really that good, it should stabilize here and go, and it didn't. And so we break this structure here, and we get a high up to this point. So this point, this price structure point is going to be critical, because now we've switched gears on the high-low game, and now we're looking at this negative structure. And here's where we're validating this breakout below the upside pivot metric boundary to trigger a reversal signal. Excuse me. And if this reversal signal is going to be true, reversals should just go, and they should be aggressive. So we should not see this market trade back above 34,840. And if it does, there's a problem. But if it holds, the expectation is that the market's going to make a play for this level. So again, looking for that, $800, 850, and risking, above here. So risking, $150, $200. And we're looking for the tails in the market, and we're going to see that in the order book as well. Is the market performing the expectation of a reversal? The fact that if we didn't have, a news event coming out soon, the market would be trading a little more smoother. Right now, it's kind of playing mind games. So it's more of, okay, we broke structure. It's more likely we're going to go sideways for a bit. We definitely have a negative lean, and it's not a real true reversal. Is really going to hold structure here and just really start building aggressive negative price action, and it's not doing that. So it's more of a tell that we may be in for more sideways, and that sideways action currently is negative below this, below this metric boundary and this price structure here. And if that price structure gets breached here, it's going to tell us that now we have more of a firm sideways expectation, and we could maybe retest the highs. But either way, we're more sideways expectation. So again, it's all about identifying context first, know your environment, be ready for it. You know, come in to the trading day knowing that my expectation is this market should trade like a bull trend. And if it's not doing that, something's going on. Are we transitioning? Are we going sideways? What's happening? Where's the alignment? Using market and price structure alignment and time frame alignment. And then that's going to align our expectations. And so we can anticipate. And so then when we're in the moment and all the all the tools that you use and the intuitiveness, the goal for the whole fact-based trading approach is to get you to help you trade more intuitively. Bottom line. When you're not thinking, you're just doing, you're executing. Because when you absorb all of this factual information, your body owns it, and it's like, okay, I feel good about that, and this makes sense. I don't have to think. And then you're in the moment with a tool like Bookmap to really dominate, and you get in sync with the order flow. But you have an expectation, and then if you are fortunate enough to get onto some good momentum, you know what you know where you can get out of that momentum. You know where you need to reduce your profit give back, and you know where your risk is at, and that is going to give you confidence when you repeat that, and that's going to make it more your account's going to be more sustainable, and you're going to start to build equity. Any questions? I've got a little bit of time on the stream. I can stay on afterwards. Also, you can email me directly. And to play around with our tools, get a 2-week free trial. You can come to dharmacapital.trade and sign up. We also have a trade room that you can come into. That we do provide other analytics and training. But keep it simple. That's what it's all about. When you go to, if you're playing cards and you know what the odds are, you're going to bet differently. You're going to make different decisions. And you don't always get the cards you want. So you play what you have. And that's a big part of it, but it's exciting when you get good cards so you can bet bigger. And if you're just not getting the opportunities, you're just not getting, the market's just not giving you the money, or when you came into trade, you weren't there for the opportunities. And if you miss something, you miss it. And that's something else to consider. That's a different presentation. But maintaining a fact focus is going to give you clarity. And it's going to make trading not as stressful. Well, thanks for joining me today, and I look forward to seeing you next time. Good luck.